Hi everyone, so my name is Hanser Herman and today I will be presenting this paper that I and my teams have made. So it's regarding the impact of interest rate fluctuation on credit risk, which credit risk is represented by NPL in Indonesia. And this analysis is the comparison between large and small banks in Indonesia. So we want to see whether large and small banks have the same association with interest rate to credit risk. So my team members consist of me, Chelsea, and Jeremy. So we are a team consisting of three people who done this paper. And I'd like to start with the introduction now. So for introduction, we see that the global financial landscape has evolved significantly, and there's greater interconnectedness among financial institutions and economies, and it causes banks to be faced to more kinds of risks, such as interest rate fluctuation. And Indonesia itself faces interest rate fluctuation issue, which stem from domestic and international economic factors, which is central bank policies, inflation rate, and global market conditions. So as the economy continues to expand and diversify, the impact of interest rate fluctuation and credit risk has been significantly increased for banks of all sizes. So why is this an important thing to study in the Indonesian economy? Because according to OJK, more than 73% of total assets of Indonesian financial system come from combined assets of Indonesian banks. So as a result, of fluctuation in Indonesian bank performance will greatly affect the economy of Indonesia, causing banking industry in Indonesia to have a crucial role on the financial system. So with that being said, it's vital for policymakers, bank regulators, investors, and broader financial community to understand how interest rate fluctuation affect credit risk in Indonesia. And our research question is, to what extent does interest rate fluctuation affect large and small Indonesian banks' credit risk as measured by NPL? And let us move on to the theoretical and literature review. So in the literature review here, we see that interest rate hold a central role in shaping a nation's economic landscape. It affects financial flow, investment, and currency domains. And the efficacy of monetary policy, which is transmission of policy rates into bank lending rates, which provide influence over bank intermediation in Indonesia, which is according to a previous paper by Sudarmono et al. And we see that there's been research that's conducted that overviews on how risk-taking channels of bank behave, according to SEGEF, that studies sensitivity of banks towards risk during the 1996 until 2008, where 96 serves as a considerable expansion in size, while in 2008, it's the lower end because it's the zero lower bound, where policymakers relate to increasingly rely on unusual monetary measures like forward guidance and quantitative easing. So other than that, there's another research that's conducted to find the correlation between banks' performance and assessed through ROE and credit risk through NPL, which is non-performing loans. And it's found that from that paper, an increased percent of risky assets cause the profits of Syrian banks to increase as capital adequacy is inversely related to the return on equity. So with all these previous papers on hand, we find that the relationship between interest rate and bank risk taking is complicated and has been widely researched. And there is no clear agreement on the precise nature of the connection, which is likely to change depending on factors such as bank's capital structure, market power, and wider economic situation. Lower interest rate, however, may lead to bank risk taking, increased bank risk taking, according to research, particularly for well-capitalized banks, while as lower interest rate reduces banks' cost of capital, making it more appealing for investors to invest in riskier assets or lend to more riskier borrowers. And let us move on to our research framework, which our first hypothesis, which is H1, is there's a positive relationship between interest rate and the non-performing loans. H2, there's a positive relationship between interest rate and the non-performing loans related to the substantial risk credit list of large banks. And H3, there is a positive relationship between interest rate and the non-performing loans related to substantial credit risk of small banks. So this is our research framework. And next on, we will be explaining our methodology by Chelsea.
Now we will be talking about the methodology. So for our study sample, we are focusing on Indonesian conventional commercial banks, which have been established and recognized by Bank Indonesia as central banks with data range between 2018 and 2022. So out of 106 existing banks in Indonesia, we only select 30 out of it because the data we get from the OJK database only 69, and the other 37 there is a missing observation for 2022 financial report data. Therefore, we can see in the table 3.1a, it is our sample banks based on assets mean categorized by size. So there are 15 largest bank with the assets mean in million rupiah, and there are another 15 smallest bank by the smallest assets mean as well. And therefore, we can see in the table 3.1b, it is the description of data variables that we use and their data sources. So there are two key variables, which are the interest rate and the non-performing loan. So for the interest rate, we abbreviated it by IR, which is the independent variable, and it is measured the BI7-day reverse repo rate average in percentage, and we got the data source from the BI7-day reverse repo rate as well. And the other variable is the non-performing loan with abbreviation of NPL, and it is our dependent variable which measures the NPL to total loans in percentage as well, and the data source is from the OJK and or the company's website. And therefore, we get the econometric models. So because the research looks at the relationship between benchmark interest rates and credit risk, whereas the credit risk is illustrated by the NPL, as well as the influence on the size of large and small banks. Therefore, to investigate this relationship, we need to estimate using the panel data in conjunction with the fixed effect model, or FEM, and random effect model, or REM. So the models we got is only 2, but as you can see here, there are 4 models, which for each models we have to divide it by the large banks and the small banks. Therefore, we got 4 models. So to determine whether to use the fixed effect model or the REM, we conduct the Hausman test, which compares the probability against a significance level. So if the p-value is lower than 0.05, we have to use the model of FEM. But if the p-value is higher than 0.05, we suggested to use the random effect model. And therefore, after we conduct the Hausman test, we get the p-value of 0.0000, which is lower than 0.05. So we have to use the FEM, the fixed effect model, that is exclusively on individuals that have many observations. And it estimates the effect of variable that exhibit variation across this observation, and it is assumed that time invariant individual specific dummy variables can capture the effects of unchanging unmeasured factors.
Okay, thank you, Chelsea. Now I'm going to explain the result and discussions from our regression analysis, examining the relationship between NPL and interest rate across different bank sizes. So in our explorations, we begin by examining the descriptive statistics, revealing some interesting insight into the variables we studied. The NPL net score showcased a mean of 0.0139, displaying a moderate standard deviation of 0.1307. On the other hand, the interest rates exhibited a higher mean of 0.0449 and a lower standard deviations of 0.075. Moving to our first tables of analysis, focusing on the large banks, we uncovered a positive correlations between interest rates and NPL. The coefficients of 0.1539 signifies the relationship, implying that as interest rates increase, NPL tends to increase as well, and vice versa. Our analysis was further supported by a significant p-value of 0.013, indicating a rejection of the null hypothesis that suggested a negative relationship. Therefore, for a large bank, there's a clear positive association between interest rates and NPL. However, the landscape changes when we shift our focus to small banks. Here, our findings display a positive correlation with a coefficient of 0.2001, suggesting a similar relationship between interest rate and NPL. But surprisingly, though the p-value of 0.365 rendered our result statistically insignificant, leading us to fail in rejecting the null hypothesis. This intriguing outcome implies that despite the observed correlations, the impact of interest rates on NPL in small banks isn't statistically significant. The discrepancy between large and small banks might be rooted in the inherent instability in the performance of smaller institutions, as highlighted by Pascal et al. 2015, where banks' performance stability is influenced by its size. Therefore, the relationship between interest rates and NPL in small banks remain less clearly defined due to their unstable operational performance. Okay, so next I will explain about the discussions. So first, our findings reveal that the effectiveness of monetary policy in influencing bank behavior is intricate and influenced by various factors in Indonesia. We witnessed a significant shift in monetary strategy, transitioning from controlling credit and interest rates to focusing on inflation targeting. These transitions demonstrates how central banks adapt strategies to match changing economic conditions. The introductions of the PI 7 days reverse repo rate in 2016 reflects ongoing efforts to refine monetary tools, promoting better financial interactions among banks and encouraging financial stability. Okay, so second, our research contributes significantly to understanding how interest rates impact bank risk-taking behaviors. It's like a puzzle. We found that when monetary policies are less strict, banks might take more risk, potentially providing more loans to riskier borrowers. However, these increased risk-taking behaviors can pose threats to financial stability, especially during prolonged periods of low interest rates. It's a delicate balance where policymakers need to be cautious about the advantages of low interest rates stimulating economic activity against the potential risks associated with increased bank risk-taking. So moving on the managerial implications, it offers insight for bank managers. Understanding the link between interest rates and credit risk, such as reflected in the NPL rates, can guide managers in responding to changes in benchmark rates. Strategies like minimizing interest rates hikes for borrowers, offering fixed interest loan products, and hedging against interest rate risk can help manage potential default on loans. However, as with any research, our research also has limitations. Challenge in data collections, gaps in earlier studies, and the time frame of our research during unusual economic events like the pandemics are worth noting. To overcome these limitations, future research could explore innovative data acquisition methods, strengthen theoretical frameworks through literature reviews, and also extend research periods to capture longer-term trends. And that's all from our group presentations. Thank you for your attention. Have a nice day.